We are joined by Tim Regan, Managing Director and Portfolio Manager at Kingwest. Great to see you.
Great to see you as well.
What are your thoughts on the markets right now, the capital markets generally?
The markets seem to be defying any tariffs coming in today.
Right.
And you look at Shopify, as we saw the chart, and Shopify would lose a lot in tariffs, so maybe the markets are right. But over the long term, they should do very well, but we'll wait and see in the next few months.
Isn't it interesting how investors are willing to take on risk given Trump's threats of a trade war?
Well, the one thing about Mr. Trump, though, is that to be reelected, or at least he can't be reelected, but at least to win the midterms, which is coming up, he needs a strong economy, he needs low inflation, and a strong market. And if the tariffs go through, unless I learned economics wrong in school, it won't be there. So is this a bluff? I hope it is.
Yeah, inflation. I mean, people think, whether rightly or wrongly, that's what caused Biden to lose the election. Inflation. Lots of other governments fell because of inflation.
And yes, I mean, those three are really what I'd say most of the people who voted for Trump elected him on. And if he can't deliver on that, I think you'll see some supporters turn on him. So, we'll see.
You have some stock ideas for us. Starting off with Royal Bank of Canada, that's somewhere you'd put money right now.
Royal Bank is a fantastic franchise. I mean, there's no denying. I was today in one of the branches as well, walking around, but it's an incredible franchise, and people forget that they have a great U.S. capital markets business. And so with the U.S. capital markets running, that really is incremental profit to Royal. But their Canadian business is by far, the retail business, fantastic. And so they're a juggernaut.
And of course, the high return on equity in banking in Canada.
I mean, if you look at it, it's 20% plus return. TD used to publish their return on equity just in retail banking. Last time I saw it was always north of 40. I don't know if they're publishing it anymore. 2 quarters ago, before they got into trouble, it was still 35%. Now, there's some capital perhaps misallocated, but 20, 30, that's just great returns.
TD Bank, you'd also be inclined to pick up some of those shares.
Yeah, I mean, TD really, as you look at it, we all know TD's troubles. But they have a new CEO who came in a little earlier. He's about to outline his game plan, apparently late in the summer or the fall, but he made some major moves, selling Schwab, buying back shares, and you know that he's incentivized. When he came in, he strikes a compensation deal, whatever the option strike price is. I mean, that's just how it works. And so he is motivated. I think he will do a good job. And so far, in the last few weeks, so far it's been great.
You have another financial lender, EQB, Equitable Bank's parent, and that stock has done so well.
It's done very well. I mean, they're leaders in all things digital. They have a tremendous franchise that's growing, and they're smaller, so they have the room to grow. They're really not even poking their heads up and bothering the big Canadian banks. So they've just been on a great tear. The stock price has more than followed their earnings. Yes, we saw a little dip, but it's back up as well. And we've actually owned Equitable for many years. We owned Equitable. We picked it up when Home Capital fell. And we noticed that Equitable didn't have the problems Home Capital did, but their shares fell in sympathy. And since then, it's been a great stock to just hold.
That's interesting. So they haven't got big enough to where they're poking the bears, the big banks.
So far, but we will see. And maybe TD with some of their cash that they have, although very unlikely, they have to find something to buy in Canada, according to the new CEO. So who knows what it will be.
Why would they allow? It baffles me regulators would allow a deal like that.
They probably wouldn't, but with everything going on, one of the things Mr. Trump's yelling about is Canada not letting U.S. banks in. And we know that U.S. banks are here, but in some areas they're not. And so maybe he's just rattling the cage and the regulators will change.
Yeah, but it kind of mystified me that Royal Bank was allowed by HSBC. But anyway, in their wisdom, they allowed it. Uber, to switch to a U.S. stock here, you see potential there.
Uber, we bought at the very beginning of the year. We see a massive amount of potential. We think the the value on the company is about $120, and that doesn't include the what we'll call the optionality of them getting into the $1 trillion automated vehicle market, the self-driving vehicles. So Uber has done very well. People forget that Uber now has, I think it's about 82 billion a year of bookings, and that's half of all the rideshare bookings in the world. Once again, they're dominant. They're making a lot of money. They'll have about $10 billion in the next 18 months of free cash flow, and that will grow, and they're looking at it growing at about 30%. So the stock is not just growing a lot, it's still very reasonable in its valuation.
Even a few years ago, some people were still saying, this is just, it's pumped up by venture capital money, it'll never really be profitable.
Well, it is, it's getting there, and it will be. And we've seen the growth. I mean, 82 billion, that's quite a bit. I think people really didn't see that Uber would take the share that they did, or that ride shares would grow this much. Obviously, we didn't, because we just bought it in January, but, better late than never.
Sure.
And it's more of a mature business now.
Right, and the stock up 35% this year, Uber. And then finally, Smart Centres, the REIT operator in Canada, arguably conventional, but also a conservative choice.
It's a very conservative choice, but if you can buy real estate at, I think the share price is just over $25, and if you can buy real estate that yields 7.5%, we think the underlying real estate, and that's lower than IFRS value, is worth about $33 a share. That's pretty good. But the one thing people forget is you have a huge option on development. Smart Centres has 84 million square feet of footage that they can actually develop. In fact, 2/3 of that has actually been zoned for mixed-use development. And so if you really look at it, what they can do is build condos over their stores. The land cost when people build condos is about 25%. It costs Smart Centres nothing. They still have the stores there. They can build over them, and they're doing it all over the place. When I say doing it, they're doing it smartly. They're not just building condos right now. They're banking a lot of the land, and you can see it in Transit City up in Vaughan, what they've done. It's just fantastic. But that option is a long-term option, a very long-term option.
And of course, they have business with Walmart. We know that. That's their core. But also Costco. I didn't know they were a big landlord there.
Yeah, they're a big landlord. You name the grocery store, the retailer, they're a big landlord. So Smart Centres is really a great conservative play. Why is it trading so low? I think people are just avoiding real estate these days.
I guess Costco has such a cult following. It might be a sales point, condos next to a Costco. Anyway, Tim, thank you very much.
Andrew, thank you.